right. There we go. I had another window open again. That happens, and then I get the feedback, and it's terrible. How you doing, friends? This is 0 Days to Expiration, and this is the final hour show. It is Thursday, November 10th, and we have another great day in the market. Well, we had the CPI numbers this morning, and that took the market off like a rocket ship. Man, holy moly. It went up, oh man, I think about 140, 150 points, something crazy like that. Yeah. It went up, it ground up, and now it's, man, I think it's right near the highs of the day today, right now. We picked two spots as we normally do, a bearish and a bullish trade, and went with the bullish, thankfully. And so it presented plenty of opportunity for people to get into a winning situation there. Yeah, let me just show you so you can see that. All right, so here the CPI was released. Wow! And then right here is where the market started. I guess the market opened right about there, right here. And this is where these are the two potential trades that we would have staged, and we picked target one. So that's been kind of my way of favoring one over the other, is make it a different color and call it a lower number. And so this is just a sample trade that I have people stage. It's not necessarily the trade, but you could just as easily have taken this trade or any other something like it that may have been within this area. But that was what I perceived as having the highest likelihood for success. And you can see that we were in this for right through almost to the, let's see, I think we hit the center spot at about 1 o'clock. So that was a great opportunity to take profits there, or anywhere along here, to tell you the truth. At that point, the gamma risk must have been relatively low. And so even if it moved out of the strategy, you were still in profit up here. But I would imagine now, near the end of the day, this is now starting to get out of profit. So lots of opportunity to take profit there. I, on the other hand, was not able to get into the trade, so I cannot record a trade. And that was because, that's because I've interviewed, I think, 4 people today. Is it 4? No, sorry, 3 people today. And so let's go back to the big head so that we can have a heart-to-heart here. All right. Okay. Yeah, so I interviewed, yeah, let's get these guys. Let's get nice and tight. There we go. The boom mics, they were way out there. All right, so yeah, I interviewed 3 new members today. Let's see, that's not true. 3 new members and 1 coaching session. So just so you know, every person that comes in through a trial, I provide a nearly an hour-long interview with them where I provide them an orientation into the service, the Discord, and all aspects of the service, the strategy, the methodology that we use, the background, everything that they need in order to get up to speed as quickly as possible. Now, I give everybody a 4-week trial. So unlike most services that only get 1 week and you never even hear from the owner, or maybe you don't even know who the owner is or who's running the show, you actually get to talk with the developer of the owner and the situation. You know, I am Coach Ernie. I am there to help you through, if I have to, handhold you through the entire process to make sure that you're successful. And when you come in as a trial member, you're no different than any other member, as far as I'm concerned. You're every bit as much of a member as anybody else, deserving the same kind of attention. So that's what I do. And that happens probably 3 or 4 times a day. It's a little crazy sometimes, And that's one of the reasons why I couldn't get into today's trade. Uh, Quite frankly, I like to tell people, well, and this is the truth, I'm probably the most distracted trader ever. I'm trying to trade this system while I am trying to run a service with 750, 800 people and 100 people in the trial, and doing these interviews all day, and at the same time doing at least 2 live streams a day, one during the middle part of the day. Oh, which reminds me, yeah, that's okay. Um, One during the middle part of the day, as well as this final hour show. So pretty busy. Yet, my performance. Oh, knocked over the water bottle. Can't do that. Yet my performance on the strategy, being as distracted as I am, is still pretty good, right? I think I'm averaging around 6% a month or something like that, and my max drawdown has been 3.25% since taking on this particular account now for the past 4 or 5 months. 4 months, I think it is. Last year, the performance was stellar. But I'm trying to put that behind me only because I feel like it was kind of fairyland make believe, with the Fed just dumping all that money into the market, and it was almost too easy to make money. And so I look at that, and although it was a great jump off for this service, and the strategy certainly performed well, I think where the real value of this strategy, this service, the system that we use here is that it's still making really good money even in a down market. The only place that we have problems with, and it's entirely manageable, are those points where we have the bear market rallies. They're tough to trade. Haven't really been able to figure that out. We tend to go kind of sideways, and then once they're over, then you just take off again. But you don't go down. That's the key. And yeah, that's I think that if I can solve that, the way I solve it is pretty simple. I simply get small. You know, the bear market rally starts. I stick with the process, and then it's like hit or miss, hit or miss, hit or miss, and then sideways. And I say, okay, let's get small. Try to wade this out. Minimize any kind of drawdown. Never had a drawdown more than, say, a little over 3%. And then once everything kind of clears, then it's off to the races. And so that's been the pattern. Yeah, I can share this with you. I'll show you. So if you want to see, what my trading performance is, you can go to the website and then click on trade log, and you can see every single one of my trades. You can see the stats, the equity curve, the drawdown charting, the frequency of, the distribution of my trades and how they're distributed according to their return, which is giving us this beautiful skewed right distribution with the nice fat tails where you want them, and then also a frequency of the type of trades that I put on, the risk to reward that I take, which tends to average around 1 to 8 or 1 to 9 or so. But anyways, let me just show you what I was talking about, these periods where you have these bear market rallies. So when I first started the account, it just took off like a jackrabbit, and then in mid-July we had this bear market rally, a really big one, and I just couldn't break out. And then finally I got small, and I did have a drawdown it went to 3.25%. You can see here's the max drawdown right here. And then after that, it seemed to break out of there. Market started to drop again, and I went up. And then had this minor skirmish here, and then back up into October, where we've had another bear market rally. And I'm just starting. It seems like I almost broke out of it, and then came back down, and then maybe I'm breaking out now. I don't know. But still, even with all of that, I'm making it sound way worse than it is, because I'm still doing really well, averaging about 6% a month. I mean, if I can do that in the course of a year, you do the math. That's way better than I even expected. I'd be happy if I was doing 3 to 4% a month. I think that would be fantastic. And if I could do that year in, year out, unbelievable. Last year, it was more like 12 or 15% a month. It was crazy. This year, I can live with 6% a month. I mean, that's fantastic as far as I'm concerned. I'd just like to figure out how to minimize these sideways moves here when we have these kind of reversal days, these intraday reversals. They just kill her, because you pick a direction and everything looks good, and then it reverses, and you don't want to go and chase it because often it will then reverse again and then reverse again. So it's crazy, that type of market. But once it's over, everything's sort of, flattens out and you go up again. So that's basically how my trading goes. And all of this data, all of this trade log data is up on the website. So right now, I think there's, I don't know, about 115 trades or so. And this here is a record of the return on my distributions and how it's showing the right skewed fat tail distribution of trades. So you can see we have lots of small losers, we're offset by lots of small wins, and then an amount of medium sized wins that kind of propel us or steer step us, and then some fat tail winners that kind of propel us. So that's the formula for positive long-term expectancy, kind of a stair stepper, low volatility, low drawdown solution to returns in your trading. So now I'm sure after about 500 trades that this line will start looking flatter and flatter and just look like bottom left to top right. So there you go. There's the performance. Looks like the average winner is about $200. The average loser is about $140. Total return after about 4 months is about 19%. So if you just expanded that out, that would be about 60% for this year or something around that. I thought there were many times that I was going to break out and get another really big return. As a matter of fact, when I said that I was a distracted trader, you have to keep in mind that I'm trading this and doing this kind of performance while I am supporting 750, 800 people and doing interviews every day and live streams every day, and then still able to do this. Now, there's been at least 3 or 4 cases where I've actually had to close a trade when I was definitely on a win streak or it was going to be a big winner. And I know for a fact that I've probably given up at least a couple $1,000s in profits because of that. So it's definitely better than this, at least for me. I don't know what other people do well in the group. Just like anywhere else, people first come in, it takes them a little while to get acclimated and get to know the system, and then they start doing better and better and better and go through their continuous improvement process. And then there are others that are a little slower, and some people don't get it, right? So I don't know how you fix that. If there was a way where you could get every single person on the same plane and make them all superstars, wouldn't that be great? And then I would have the perfect service, but that's not possible. It's unrealistic. So I do what I can. I provide the best possible support and coaching and mentoring that is available. This is starting to sound like a big commercial, isn't it? All right. What was I supposed to talk about today? Let's see. What was the topic for today? I have to go find it. Can you imagine that? I forgot what the topic was. I'm sure somebody in the chat will tell me by the time I find it, right? I have to actually go to my YouTube channel to find out what I'm supposed to talk about today. Oh yes, how to double or triple your account with 0 DTE. Yeah, that was interesting. Now I don't know how many people are going to look at that and say, "Ah, what the hell are you talking about? Or any double or triple your account? You can't do that's crazy." Trying to lead. Is that clickbait? Oh yeah, it's kind of clickbait. It's a little bit clickbait, but not really. So let me just say that last year, when I first started this service, we were trading almost exclusively the E-mini S&P futures contract. This year, we're trading the SPX, the options on the index, the SPX index. And the reason why we were trading the E-mini last year was that I felt like we had another opportunity, because it trades around the clock, to trade outside of market hours. And plus, it wasn't subject to the pattern day trader rule. The only real caveat to it was that you could get assigned if you were in the money and you brought it to expiration. But it was still a great, and well, it had one other caveat to it, and that was that the commissions on the E-mini futures options are definitely pretty high. They're probably 3 or 4 times higher than they are on the SPX. There are some services that do much better than others. I think that Interactive Broker probably has the best commission plan. It's the cheapest, followed by probably, I don't know. There's probably others out there, but I like TD Ameritrade and maybe, well, Charles Schwab owns TD Ameritrade. There's been a few others. Tastyworks is probably near the bottom. They're probably the most expensive, I would say, because they also will charge you an exorbitant fee for allowing something to go to expiration, and what they call the assignment fee. Even though I don't know where they come up with this stuff, why you get an assignment fee. Why doesn't the other brokers charge that? It's crazy, but they charge like $15. That's nuts. I don't know, Tom Sosnoff. What's he thinking? So anyways, yeah, we traded the E-mini futures last year, and even with its caveats, it was a fantastic year. But I think a lot of that had to do with just the quality of the year. We had this bull market going. It didn't seem like you could do any wrong, and making profit left and right, and pin trades all over the place, sometimes 2 pin trades in a week. It was crazy. And yeah, tripled the account in that period of time. So I look at that and I say, yeah, it's possible to triple your account with this, but I don't know if that will ever have that kind of market environment again, where money is being pumped in, volatility is, okay, but it's just going up. You just pick one direction and go that way. So that gives you, I think, a false sense of security with that strategy. I mean, I was happy to make that kind of money, but then when the everything turned in January, it became a different story. And so then the question was, well, will this strategy survive? Also around that time, they weren't as happy with, because as the service got bigger, people weren't as happy with the E-mini and the cost of it, the commissions. So I started to switch more to the SPX, and I also recognized that once all of the hopium went away and the pumping of cash into the market, it became a little bit more difficult. Instead of making 12-15% a month, it started to drop to about 1/3 or 1/2 or 1/3 of that, down to about 6%. And you actually had to work for the money. But still, it was still good. And is it possible to double or triple your account with this strategy? Sure. And of course, I'm referring to, and you have to assume when I say that, I'm talking about in the context of a year. I would say that it's now, in this kind of market, it's probably not as likely. And like I said, I don't know if we'll enter that kind of market again. It would be wonderful if we do. Um, but yeah, it's absolutely possible. Should you expect it? That's the real question. And that answer is absolutely not. Because you have to look at any strategy and anything that you engage in and what your long-term expectancy and performance is going to be and what's realistic. And when you compare this to what other people are doing, the best traders in the world, and whether or not, how much do they make? Are they making, 20%, 30, 50? What are they doing during down markets? What are they doing during up markets? If you look at some of the best traders in the world that have been doing consistent performance year in, year out for, a decade or more, the best of the best are doing 30%. There may be a few doing 50%, but they're few and far between. So if you were to then use that as sort of your standard, your gold standard, that's what you would like to attain. And I think it would be super ambitious because to assume that you're automatically in the 0.1% top tier of all traders just because you started a strategy is a little bit, just a little bit delusional. But hey, you got to have goals, right? So yeah, you could probably make 30, 40%, but what does that really mean? Let's say that you had a $100,000 account and you made 30%. What does that entail? And this puts it all into perspective, especially with people that come into a service like this and want to know, well, how much can I make per week? Right? Because everybody asks that. Well, what kind of income can I generate? And I say, income in the market? What do you mean income? The market doesn't give income. You think the market just sits still and just, I don't know, passes out bills on a regular basis? That doesn't happen. So there's no income. There's no crying and trading. All right. But let's say you make 30% on a $100,000 account. So that's $30,000. You made $30,000. Let's break that down by week. Divide that by 52 weeks. Right? That's $576. That's averaging that every week. And that might not seem like a lot, but doing that every week with a $100,000 account, that's pretty good performance. That's top tier performance. That's the best of the best of the best performance. With a $100,000 account pulling in $577, right? If that's let's say that's a $25,000 account, right? And you make times 0.3, you make $7,500 divided by 52. That's $144 a week. Can you make $144 a week consistently every week, year in, year out? If you did, then you would be one of the top traders in the world. Right? So put that in perspective. So when people come in and think, well, with 25,000, I should be able to do 1% a month or 1% a week, right? I think some people claim that you can do 1% a week. All right, let's say you do 1% a week. I don't know. I'm not going to even do the compounding part, right? But 25,000 times 0.01 is $250 a week times 52. That means you make 13,000 divided by 25. That's over a 50% return. 1% a week. Is that right? Yeah. No, that wasn't right. Yeah, I guess it was. 1% a week. 25,000. Let's do that again. Times 0.01 is $250 times 52 is 13,000. Yeah. So it's that's super. That's okay. I guess you could do 1% a week. What about 1% a day? You could do 50%, I think, with a $25,000 account. What about 1% a day? There are 220 trading days in a year, right? So if we went 25,000 times 0.01 is $250 times 220. Whoa, that's $55,000. So divided by 25,000, that's 220%. So do you really think that that's what you can do? 1% a day, $250 a day off of a $25,000 account. Can you do that consistently year in, year out without having any big drawdowns? I I would be probably willing to take that bet. In other words, I would finance your trading account. I would become your broker. And I would take that bet because I think that that would be better than buying whole life insurance or something. Much better. So yeah, when you're talking about doubling or tripling your account, I mean that happens every once in a while. It's a conditional. If you think that there's a strategy out there where you can make 1% a day, then you might do it for a few weeks or a couple of months, maybe even a few months. But then there's going to be a big drawdown. You're going to probably go down to zero or lower and start all over again. More than likely. I mean, that's what happens. I mean, look, if it were true, there would be people out there that are teaching whatever service it is that does that, and everyone would be flocking to it like fly on shit, for sure. With us, we take like the hare and the tortoise approach, the rational approach, and even then we're shooting for some lofty goals, but we're realistic, and we take very, very little risk for huge outsized gains, and we're patient. And then that seems to be a winning formula. But you can't push it. You know, some people might say, well, Ernie, if it's so good, why don't you just crank up the size of your bet? Well, when you crank it up, the more you crank it up, the closer you get to this idea of high probability. And that's what ruins. The high probability strategy is what ruins you. All right. So let's go and do a roll call. Let's see. First of all, let's go to the big head here. Wasabi. I love wasabi, Landon. It's my favorite thing to put on sushi. I like the big gobs of it and then how it feels when it goes up in the back of your nasal passages and makes your eyes kind of water and tingle. That's the best. I don't know why you're saying wasabi. Maybe that is that some sort of greeting? And there's Is with hello, hello, how you doing? And Michael Lee is here. The Power Hour. Yeah. I don't know how much of a power hour it is. What are we doing here? Oh, it is man. It's just taking off. I was just looking at the market. Yeah, Brent's here. How you doing, Brent? And Giannis. Nice to see you, Giannis. Dikanis. Giannis. And Donald Steele. Nice to see you. Oh, thanks, Is. He was telling me what my account was. You can always count on Is to give me a hand. And Rob is here. Better late than never. Giannis says, hey, Ernie, when you get assigned in the E-minis, you pay the notional value or just the margin? The margin. So, yeah, there's your initial margin and maintenance margin, which are a little bit different. But your initial margin's a little bit lower, I believe, and then your maintenance margin's a little bit higher. Might be the other way around. I haven't traded futures for so long. But anyways, you pay margin. So on the E-mini S&P currently, I think that's around, I don't know, $13,000-$14,000. So you need to have $13,000-$14,000 per contract in order to hold an E-mini contract in your account. So if you get assigned and you don't have that amount of money in your account, then they're going to pull it out and then they're going to put a lock on your account and you won't be able to do anything until you call them up and beg them to take the lock off. That's what will happen. 123 Happy Street says, yo, how you doing? And Jamie is here. Hello, Jamie. Let's see. Jamie says he sold the last two tranches of a 3850 20 wide at $835. But what did you pay for it? I know you probably paid, I'm going to guess, 20 wide. You had to have paid somewhere between $2 and $2.50. Or did you pay close to $3? That's what I need to know. Because if it was $2 to $2.50, then you would have been right within our guidelines in terms of what to pay for risk to reward. But either way, let's say that you paid $3. That's still huge, huge, huge. All right, Don H is here. I'm playing the averages. There are really bad traders out there. I just need to be faster than them and not to get caught by the bear. Okay, I hope. So Jamie says, sign me up. You can fund my account if you want to. No, that does not apply to anybody that's in my service. All right. So yeah, I retract that offer for anybody in the service. Jamo or Jamo Jones, how you doing? And Nino Garcia, nice to see you. Oh, $1.90. That's an excellent price. So you're up around 1 to 8, 1 to 9 risk to reward on that. That's a fantastic price. Let's figure that out. So at 2 minus 190 divided by 190 is so that's a 1.95, 1 to 9.5 risk to reward. And what you got 850 back, so 850 minus 190 is 66 divided by 1.9. So that's about a 350% return. Wait a minute, hold on. Yeah, had to add that. Good job. All right, so it is 3:35. There is no way that we're still in this trade. The market is just going nuts. But maybe we can do an analysis of where we think it might go. Of course, we had the good CPI numbers this morning, claiming that, I guess the claim now is that inflation is under control. Right now, inflation is only 7.5 or 7.7 cents or 7.7%, right? We're out of the woods, right? Still. Yeah, your costs are only going to double every 5 years now, so no worries. Or 10 years or whatever it is. Is that the rule of sevens? I guess that would be every 10 years. So the car that you bought today for $50,000 in 10 years is going to cost you $100,000. Yeah. Unbelievable. Okay, so let's see here. So yeah, Don says it's only 7.7%. Of course, we know that that's a lie. Inflation is not 7.7%. The reason why it's that low is that they include a metric in there called Homer. Yeah, it's duh. It's Homer. No, they include the homeowner's equivalent rent. So and that comprises something like, I don't know, 30 or 40% of the total inflation. Is that how they do it? Yeah. So anyways, they go and they ask homeowners, so if you had to rent, what would you charge? And of course, what does a owner know about that, about renting out their property? They don't do that. Why do they ask that question? Why don't they just go and find out what the average rent actually increased? That makes no sense. Well, I know why they do it. They do it because they know they're going to get a lower number, a much, much, much lower number. Because if they went out and looked at the actual increase in rents, I'll bet you that it's 20% or more. And if it's 20% or more, then our inflation is way, way higher than 7.7%. Way higher. So that just goes without saying. Let's see. I want to see where the market's going here. Let me just check for you so you don't have to. And I'll bring it up if I think you do have to see it. Wow. Look at that. Yeah, you probably want to see this. Um, okay. Just want to see where we're at. I need to bring all this into perspective. All right. So I'm going to show you this. Hold on to your hats. So I know there's a lot of markup here, but we started the day right here, and now we're right here. So what is that? That is 3750 to 3950. 200 points? Am I reading that right? A 200-point move today. 200 points in the S&P. That's crazy. Oh, that's so crazy. 200-point move. When was the last time we had a 200-point move? Well, let's see here. I think this was more than in the course of a day. All right. Yeah, so this was 2 days. 2 days we went from 3570 to 3807. And so that's more. So that's 100, that's 230 points. But that's over 2 days straight up. This is 1 day. Now, it's not like that's unusual in the grand scheme of things. You know, you look at that move, then you look at this move here in mid-November or early November, sorry. And then this move here in late October, and then this move here in mid-October, and then this move here in also mid-October, and this move here in early October. I mean, we had some mammoth moves. Look at these moves. Look at it. Look at it. Just look. Oh my God. Yeah. That is fear in the market. So this right here on October 13th is the low in this bear market. And we're currently on what I call another bear market rally. And I've been doing okay. We're trading smaller, so that's why my performance is going sideways, because we're in this bear market rally. See right here? That's what happens during bear market rallies. You go sideways. I wish I could just elongate all those. If I just get rid of the losses here, I would be like way up here, you know, making 20% a month. But losses, unfortunately, come with the game. The difference, though, between this and the high probability strategies is that when I make a win, my win is 10 times the size of their win. And when they make a loss, their loss is like 10 times the size of my loss. So we win on both sides. It's not quite that much. On average, we are about 30 times more cost efficient on average. So in other words, we use about 30 times less money to make the same equivalent money. All right, let's see here. Let's go back to the charts. See if we can look at a day view, if that will give us any particular insight. So here's the entire bear market rally. I had to put on some extra annotations this afternoon after the market started to take off, so that we would be able to do some analysis on the market tonight and tomorrow. So I had to put this new T3 node up here, and then the LVLs designated by these purple lines, which are very impactful. And we're probably going to hit the top of this huge node here. We're just about there. See, we're right here, right below it. We're just below it. If we break above, let's say 39.75, then this market's going up. Potentially another 50 points. Is that how much? 39.75 to 40. Oh, it's more than that. 150 points. So potentially another 150 points from here to here through this chasm. Yep. All right. Let's see. We've done just not buying it. Feels like a rug pull is coming. Bad day for the bear call. Credit spread sellers. Yeah. Yeah. Today was not a bear call. We didn't call a bear. We called the bull. Although in previous last week, it was for whatever reason, I think that I made, 5 really great calls. As a matter of fact, 3 of them, price had actually gone into our profit tent, but then immediately got evacuated one time because Jerry Powell came out and just totally upended me. And so I ended up with 5 bad days in a row, which was really, really tough. You know, it's tough when you know you have the analysis right, but then the market decides to go the other way for whatever reason. Like Uncle Jerry Powell decides to become super hawkish when everyone is interpreting the Fed minutes as kind of milk toast, not anything. And I had a bullish trade on that day, and it was up there sitting right on the center strikes. And then he comes out and starts spewing his stuff, and just went down hard. That was a tough day. That's okay. On days like that, when you're in this strategy, those days, even though they're disappointing, still the losses are so super small because we define our risk very, very small. Never really worried about it. Just, you just want to get out there and just strangle someone though, because you say, I don't care how much it is. It could have been a nickel. Just saying that, man, I had everything set up and you went and just totally destroyed it by, completely doing an end around. All right. So I don't have a whole lot more to say. I don't know that I want to sit here and predict where the market's going to go today. I would rather just put this aside. We did well today. Another 3 days, 4 days in a row, and then go out and get out there in the trails with the dogs, hang out, go see if we can chase down some coyote. Something like that. All right. And then just see where the chips fall tomorrow, because I don't know. We're heading into this volume well here, and I think that there's a good chance the market's going to go up, 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 and made some good bets on gold over the past couple of days. I've been telling everybody, getting gold, getting gold. I've been telling our group and this other group I'm in, and look at that, over 5 days. Bam, 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 triple banger. Now we're here. I think that we go to here approximately. 1800. I think we get to 1800, and then that's where we can take some short-term profits. Right there, 1800, and then on any pullback, buy more, because the next level will be here. 1850, and that will be another breakout area. Then to here, to 1925, and then to here. Just keep on climbing that wall. But anyways, that's what I've been telling everybody in the group. You got to buy gold. Got a dollar cost. That's my plan now, is to dollar cost average into gold, and gold royals and streamers, and a few other resource stocks. When I say resource stocks, I'm talking about energy stocks like oil, gold, um, rare earth, minerals, that sort of thing. Because I think that those are now going to see a new move, and that's where we're going. Up, 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 up. And I think that we're going to see the dollar come down. Let's see, where's the dollar? Where's oil? Oil didn't do much today. I'm surprised that we moved down these past 2 days, but oil didn't do much. We had 2 days of two dojis that look like twin dojis there. Right there. Let's take a closer look at that. Is that two, or is that just me with bad eyesight? No, it's one. I thought I was seeing double doji. So that's a doji. I think that is a reversal. That's a reversal pattern. We're going to see gold go up. That's what we're going to see, gold go up. I really thought that was two. I got to get new glasses. Yeah, oil's going up because they're doing everything in their power, this administration, to make the refinement of oil hard. They're also getting rid of coal power. I mean, he said the other day they're trying to shut down all the plants. That means that there will be further demand on oil. And yeah, I think oil is going to take off. Once it gets beyond this, I think the next stop is 100 again. And of course, that's going to sort of wipe out the CPI numbers from today. And I think inflation will start going up again. And it's amazing that we're not higher as it is now with oil elevated like this, but it's going higher. And this is after all of this down movement here has nothing to do with supply and demand. If they did not open up the strategic reserve, we would still be up here at 120. And the only reason we're down is because they went through the strategic reserve and now they're going to have to replenish it at this higher price. A good portion of that oil that was in the strategic reserve was bought when oil was down in the 20s during the Trump administration. All right. Garcia says, does the price behave the same when arrives the HVN or LVN? I mean, both behave as support and resistance. No, HVN and LVNs have nothing to do with support and resistance. Absolutely nothing. That's a misnomer. And I'll prove it, right? The HVN and LVN is defined as the area within a volume profile that is showing supposedly one standard deviation of all the volume that is existing in that profile, or 68%. Of course, they rounded up to 70%, further bolstering my supposition that the HVN and LVN are completely arbitrary and have nothing, absolutely nothing, to do with support and resistance. All right, so let's do that. Let's go in here and we will create the value area volume by putting in that 68%, which is supposed to represent one standard deviation. That's what it's supposed to represent. All right, see how it darkened the top and bottom here and left this part, kind of bright? So what they're referring to as the HVN and LVN is this line, the demarcation between light and dark, as if that somehow has some significance to the market. Now, the market has no idea that that's there, and That's the HVN, and that the LVN is here. Because first of all, the only reason it's there is I chose the number 78%. Now, if I were one of the stooges that feed you this bull, they'll say, "Oh, well, no, we use 70%." Okay, well, let's use 70%. All right, so now we're using 70%, and it's outside of that line. All right, so, and it didn't go equidistant down here. So you're telling me that 70% is the new number? That's the number that the market is, and how do you know that this one down here didn't move? So we're saying, oh, no, it's this. That's what the HVN is. No, that's bullcrap too, because that's just an arbitrary number. Why not? I think the HVN should be not 70 or 60. I think it should be 37.4%. Can I put a point? No, it doesn't let. I think 37% then. Round down. Yeah, that's what I think. Why is my 37.4% any less valid than 68%? Tell me. I'm not yelling at you, Nino. I'm yelling at the world that even uses the stupidest concept ever, HVN and LVN, as if it has some significance. It is completely arbitrary. It means nothing. Yeah, just as JP says, just create a line wherever you want it, and then call it something. You can call it the Garcia line, right? We are now going to use the Garcia indicator, and the way it works is I go round and round and round and round and round like this. I close my eyes, then I stop. Open my eyes. Where is it? Up. There's the Garcia line. Right there. I'm gonna name it. And we're gonna call that the Garcia value node. It's the GVN. There it is. There's GVN. That's every bit as valid as the HVN. So, no, what I was saying is, and so I answer your question, because your real question is you want to get an understanding of how to determine where support and resistance is on a value node, right? So the way you do that is you have to look at the leading edge, the top and bottom most dramatic fall off of volume to no volume on a node. And that's the important part. The other important part, and see, we can go to the ES here. And you can see how I mark them off with the rectangles. So these shaded areas, they get the top and the bottom, and they find the steepest version of those. And that's that will show support and resistance there. Then you'll see these purple lines, the purple lines that come down here and then pick off the very lowest points inside the volume wells, this complete dearth of volume. Those are significant too. And any place where you can see a very, very sharp level drop off of volume, you can also pick that off. So those are the inflection points. That's where the market is going to find support and resistance. Those points where the market has either completely ignored volume or has had a sudden shift from hardly any volume to volume. Right? Those are going to be the important points. So that's what I mark up. I only mark up the nodes and the top and bottom of their most dramatic up or downswing, from volume to no volume, and in between the nodes where there's the lowest possible amount of volume, where that drops off dramatically. Again, that's where you mark those up. And then all of those lines will show you, when you zoom in on price, how price is just 100% following those lines, as if they were drawn by magic. When I didn't draw them by magic, I just looked at the chart and lined them up with the features of the chart, and then price magically then follows those lines. That's because the market structure is actually visible. When you hear technical analysts, they talk about market structure. You can't actually visualize the structure. They talk about it and they start drawing lines all over the place, and they're usually drawn from arbitrary points like moving averages and stuff like that, but you can't actually see it. The volume profile literally shows you, it's the topological map of the market structure. All right, so Nino saying, thanks, Ernie. So on the lack of volume peaks, the price generally doesn't stop. So yeah, that's a good point, that when you're in one of these areas that has a lack of volume, consider this. If there's a lack of volume, then what is there? Well, nothing, right? So that would also be considered a low liquidity area. There's nothing there. And so what happens, like, look at it this way. Low liquidity and high liquidity. We'll consider a tub of water as being high liquidity because there's a bunch of water in it. So when you put your hand in it and try to go back and forth with your hand, you feel resistance back and forth because there's liquidity. Then you take your hand out of the water into the air where there's no water or no liquidity and move your hand back and forth, and there's no resistance. Same thing. You go above the value node and there's no volume there, there's no resistance or very little. And so big money with the ability to push markets, that's where they're going to push markets. They're going to push it up or push it down into one of the higher liquidity areas until they find value. That's how it works. And then when they hit the high liquidity area, they slow down. It's like, feet in the mud or a hand in the water. So the little lines, the purple lines, that's the craziest thing, is that that's marking the transitions from high value to low value. Even in these deep crevices, they also seem to have special power. For whatever reason, the big concerns, the big money, are lining up their orders right around there. Don't know why, but that's why you have these little crevices in the volume profile that persist. Why? Why do they persist? Is there like an actual answer? Can you go in there and then quiz all of these people that are trading, that are slinging around millions of dollars? Why won't you use? Why will you not put a trade on at 35.8750? Why? I want to know. Want to know now. Why every time you and all of your banker friends and the investment house down the street and the prop trading firm over there, they refuse to trade 38.57, or I'm sorry, 35.8750. Why? Let us know. What's in there? I think there's something hiding in there. It really doesn't matter why. It just is. That's for whatever reason. It's a cumulative mass hysteria type decision where they all decide that's where they're not going to trade. They're not going to take any trades there, no matter what. You can't force me. All right. Nino says, maybe then algos take action on these zones. Well, of course. I mean, there is something that is set up there, but are you saying then that all the algos in all the world are all avoiding the exact same price? Maybe. I guess that could be. It sounds like a conspiracy to me. Why? Why are they all just saying, nope, can't go there? like look at this price right here in between the T1 and T3 node, way down in here. So there's a little stretch of prices right in here between 49.40 and 49.45. For whatever reason, all of the traders all over the world have decided that that's pretty much a no-go zone. See, the thing is, does it really matter why? I suppose, just as an intellectual pursuit, you'd like to know why. Why are they doing this? But nobody really knows. There was a trade that I used to do, and I've talked about this before on here with Apple. You would open up an Apple position on Friday morning, and only if the market was trending up in Apple before noontime. So before noon, you open up a long position only if price was trending up in that morning. All right. I don't know why, but that's what you do. And then you close it before noontime on Monday. For about 30 years, that had an 80% probability of coming out positive for 30 years. So you know what I did? I started a service around it. I called it the over the weekend trade, the OTW. And I'm sure that there are people listening right now that were part of that. Pretty good chance. The OTW trade was fantastic for about, I don't know, a year and a half, 2 years, something like that. And then all of a sudden, one day, it stopped. Just stopped. Cold as a fish. Cold, stopped working. And then after about 2-3 months, everyone said, well, I think the game's up, Ernie. They would pay me a lot of money too. I said, yeah, I guess the game's up. So I had to close the doors. Then 6 months later, it started up again. And I think it's still going to this day. I haven't checked it lately, so you'd have to tell me. But that's the criteria. Like you could use like a simple 10-day moving average to check whether or not price is moving up or not. Go long on Apple on Friday, get off. And here's the other cool thing. If you took it off on Tuesday at noon, you could add another 10% onto the returns. That was a little less reliable, but it was still pretty good. I don't know why. Why did it stop for 6 months? For 6 months, just did not give a signal, did not do it, just wouldn't do it. Wouldn't do it, couldn't do it. Those are the mysteries of the market. It's just the way the market is. You find these little things, and then you can exploit them for a little bit until somebody else finds out. Then you can't. But the market structure stuff, that is incredible stuff. And that was actually noticed by some serious mathematicians back in the 60s and the 70s, principally Benoit Mandelbrot of fractal geometry and Mandelbrot sets. He noticed that there was market memory. And then there were a number of other people that wrote academic papers on it and actually did studies to validate what he was saying. And we can see that today simply by looking at it, looking at the volume profile and then drawing those lines. And we're seeing the same thing that they pointed out through math. And there it is. And yet nobody in the area of volume profile analysis sees this except for me and anybody I show. I show people and they say, wow, that is really weird. Because when you zoom in on price, you start realizing that all the prices are now following along with those lines that I drew. Really weird. Nobody else will show it. It's there. It's an exclusive. I don't know how exclusive it is. I talk about it almost every day and tell people that it's there, and nobody seems to care. Yet it's probably one of the most powerful indicators ever for a day trader or a swing trader. Man, you can make a living off of it. We kind of do. All right. Oh, I can't believe that I missed the close. Let's see where we're at. Look at that. Look at that market. Just blasted right through to that T2 node. And it looks like we stopped right at that. See that purple line? Yeah, we stopped right there. And I suspect that tomorrow will probably, overnight, we'll probably bounce off that purple line a few times and then go higher to the next purple line. There's a few purple lines in the way before it gets to this next node, the T3 node up top. That's where it's heading. It's heading to the T3 node. That's where it's going, right there. So Don says, overnight and open will be and the open will be interesting. Yes, it will be. All right. I think I'm talked out, and hopefully you found some interest in the things that I talked about today, particularly about expectations, setting expectations about doubling and tripling accounts, and how dumb that is. Yeah, that's exactly right. No resistance, just some. Well, the purple lines, they do represent some kind of resistance. I like to think of them as gateways. They either will reject price or they will allow it through. But they almost always, you'll find that price will interact with them and then either stall or stop or bounce off of them and then go to the next one, and then the next one, and then the next one. All right. Thank you very much, Jamie. Take care. And it's time to go. Got to get the big head back here. Man, I need a shave. Yeah. Need a shave. Uh-oh. The alarm has gone off. Time to go. Peace to you all. Oh, peace to you all. Hope you have a great day. We'll see you tomorrow, and more of this stuff. So looks like four good trades in a row. That's great. See ya. Love you.